Welcome back to It's Only Money here on whatever listening device you're listening to. It could be the radio. We got podcasts. You can do it from any podcast streaming service. And we got all the past episodes on EdgewaterFamilyWealth.com. By the way, Edgewater Family Wealth is who we're talking with today with Scott Brown and Tammy. And the website is where you want to go to get all the contact information and all the things that you need, really. But good morning, fellas. How are we doing?
Doing well. Good morning.
Outstanding this fine weekend. Florida weekend. Summer's here, by the way.
Is it?
Yeah, it's hot.
Well, yeah, Florida summer is just our Florida winter, which was 2 weeks ago, ended, and it's only for 3 weeks, and now we get massive hailstorms and just hurricanes from here on out. What a beautiful state! Please move here.
You don't have to ask; they're moving here.
I know, that's crazy to me because, like, if you gave me a point objectively, you said, Ryan, you can live anywhere in the world.
Yeah.
You can pick.
Mm-hmm.
It wouldn't be Florida.
No? What would it be?
Well, it would probably be one of the Nordic countries, to be honest with you. I'm in love with them. But Florida, just from a lot goes wrong here all the time.
Yeah.
From, just we're a mosquito swamp.
Yeah.
We have hurricanes. We have hail.
Alligators.
And eventually the sea is going to rise and engulf the entire state.
And you can be eaten by an alligator.
All of those combined?
So I'm a fourth generation Floridian, so I'm a little, proud of that. But ever since Florida Man, the Florida Man headline started 5, 6, 7 years ago, where every time you pick up the newspaper, something stupid happened. It was Florida Man.
Yeah.
I really feel like I want to put the record straight here, because it's never really Florida Man.
No,
it's Michigan man that moved to Florida and did something dumb, or New York man that moved to Florida and did. It's not us. It's not actual Florida Man. We know what we're doing. Right?
Yes, the real Florida, if you check their history, they're always from somewhere else. It's because of the sunshine laws that we have also. So we have very open, very searchable things that if you get convicted of a crime, if they put it in a database, you can look it up. There's only a few other states that have it, like Ohio, I believe, has it as well. So they focus on us because it's easy to pull our shenanigans.
Yes, that's true.
Yeah, but I mean, actual Florida man knows not to feed potato chips to a 12-foot alligator, right? Michigan Florida man doesn't know that, which is why he makes the news, right?
Yeah, I was looking at funny you say Michigan though, because I was looking at a place that because I'm always looking at futurist videos and things like that, and it's okay, if there is a severe global warming and the seas do rise, where you'd want to move ideally would be the Michigan area.
Oh,
because and I'm should I buy property in Michigan right now just to have it and ready to go?
But they're also on the Great Lakes. Does that nothing affects the Great Lakes?
I guess not.
Because there's no glaciers flowing into the Great Lakes or something. I don't know how all that works. But
I don't think they would have to worry about a sea level rise there.
Right.
And that was the other part. So if global warming is going to cause a mass shift in temperatures, places like Florida would become unlivable.
Yeah.
So then the more temperate zone actually becomes Michigan, and that longitudinal.
Yeah, one of those.
So you'd want to live up in that area.
So then oceanfront would be northern Mississippi or something.
Pretty much.
Yeah, and then you're saying the temperate area would be Michigan, more comfortable, and Canada would be a little frostier. But not frigid like it is right now.
Yeah, so that's honestly when I think of investing in the future, it's literally I've had this conversation with my wife, which is okay, so if we were to invest in Michigan, though, would you be down?
And she says?
She's unfortunately with me on a lot of my nonsense.
That's not good.
But when it's on paper, Scott, when the temperatures are rising, I mean, when you build an investment strategy, do you think that far into the future with it?
Oh, no. Now you're going to get us all in trouble. Because if you say those 3 letters, people get very opinionated one way or the other. And I'm not saying those 3 letters that start with E and end in G, because it makes people very mad, Ryan.
3 letters that start with E and end G. I don't even know.
Yeah, the middle letter's S. All right, so it's environmentally. What does it sound? Governance or something?
Oh,
yes. Is that what it stands? Socially, sound governance.
Socially, energily, happily, something. Environmentally. It's basically green stuff that there are mandates in certain states that you do it, and then mandates in other states that you're not allowed to do it. And it's first of all, nobody's really paying that much attention to it. It's just something to talk about. It's a marketing thing in my mind. Not to say that there's not validity to one side or the other, meaning, if you're a person who is more green, we'll use that term, than others, you're more concerned with the environment or things like the environment. There are other obviously social issues I won't even begin to dip a toe into. But if you look at the environmentally, concerned citizen, they might want something, invest in a company that is also to their, in line with their thinking. If you're a person who finds that irritating that people are like that, then you want to maybe invest with a company that doesn't care about those sort of things and is more profit driven. And I don't know that they're disconnected. I don't think being aware that your factory could be affected by climate change, if you believe that to be a thing, so you have to disclaim everything I say now. It's like,
I don't think you do. I think I think we could agree that the world is getting warmer. It's the reasoning for it.
Why is
what
it
people
getting
are?
warmer? Yes. So I'll let you all figure that out because you're all way smarter than me. But let's say that the climate is getting warmer, which I believe is true. It does make sense as a company to say, well, how's it going to affect us? Do we have a factory somewhere that could be affected by that? Does it affect the crop that we use to make our product? These are the sort of things that you must at least think about as a company. I know at Raymond James, who is our broker dealers, who we clear our business through, they have offsite. So they're based in St. Petersburg, and they know if a hurricane comes, that's problematic for the company, right? So they have created places throughout the country to run operations should a hurricane come through St. Petersburg, like Denver and places like that rarely see a hurricane, right? So it does make sense to think about these things. How caught up you get in it, how angry you get about it is up to you. I'll let you do that on your own. Really, we're here to talk about money and to talk about how to maximize your potential wealth, which is why we're doing the what?
We are doing the numbers with the number one money man in the business.
Numbers guy.
Number one guy, Tammy with them numbers.
Right. Numbers. Previously, Ryan, you walked in the studio and you held that tablet. What I read the numbers.
I held
from.
the numbers tablet.
How did that feel?
Honestly, it felt like I felt a Spider-Man quote: "With great power comes great responsibility."
Right.
So you put it down.
Until I put it down. I should never be in charge of the numbers. No, the numbers song.
Yeah, that's good.
Tammy is running the numbers for the whole world from that tablet.
Responsibility.
That his tablet weirdly even felt heavier than a normal tablet, which I'm assuming is because it's filled with the numbers.
That's right. Numbers are very heavy.
They are heavy, man.
Yeah.
They're heavy.
It's a heavy
you see
responsibility.
Me walking by, I'm like, I'm kind of a hinge like this because of
But it was lots of charts and colors and numbers, and to be honest, to me, it looked like the most boring thing in the world. But for Tammy, this is the magic and the juice of life.
It really is the juice of life for him.
It takes some time because those mean a lot. It could be reflecting on our lives and clients and everybody around us if we pay a little bit attention. And our listeners, they don't have to. We can do it for them. That's the point. We're here.
Is that why we're here?
Yeah.
Okay. Good. Check it.
I think that should be reiterated. It's the Edgewater Family Wealth. Now your mind no longer has to think about the money and the future because you got Tammy there with the numbers working for you.
Exactly.
That's right.
Exactly. Like, don't look to the numbers.
Tammy's brain is your brain.
Yeah, I like that.
Yeah.
Sheer capacity. So on the number side, I think this week the advanced GDP number came out. And we're still not in a recession, still positive.
When is this recession I keep getting promised coming?
I don't know.
They keep telling me it's coming. I'm waiting.
I've seen all kinds of charts with people pointing at this right here is when it happened in 2008.
Mm-hmm.
Yeah, but no, still not. But that doesn't mean there's not slowdown because previous quarter we were almost double the growth.
Yeah.
We were at 2.6, I think, and now we're at 1.1 for this quarter.
Yeah.
But that was all. We all know that. It was not a surprise.
No.
Slowing down.
But it makes for a good headline.
It does make for a good
If you
headline.
say a recession's coming every single day, eventually you're going to be right.
Yeah.
See, I told you. Yeah, but you started telling us 3 years ago.
And then once upon a time it happens, and then that was it.
Now I'm a genius. I got it. Yeah.
But other than the GDP number and the big headlines right there, we also have other big lines all the time. This time it's earnings for the quarter that we just passed. The big names like what we say banking, those are the big ones.
Yeah.
We're talking JP Morgan, Citigroup, Goldman Sachs, etc. All of them, literally all of them, had a growth quarter over quarter for their earnings.
So they're not falling apart at the seams.
They don't seem to be.
Yeah,
so
they're
far.
still making money. Go figure, banks are still making money. Who knew?
No, those are the major ones. The one that are struggling a little bit more though are the regional ones.
Such as
we're talking. Do I say that name? First Republic.
Yeah. Well, yeah, that's exceptional struggle right there. But
is that one being taken over officially, or
I think they're in the process of figuring that out still. Truist, is that a regional?
The Truist is regional. It is slightly up for the quarter, the previous quarter, so it's not as bad. Same thing for Northwest
Regions.
Regions. Their earning didn't come out yet, but those are the ones that we're looking into. Furthermore,
no, we got
you scared him when you did that.
What happened there? Okay.
We got a lot of numbers and we got a lot of time, so we'll be right back with more numbers with Tammy. Until then, take your time, go over to edgewaterfamilywealth.com, check out the website, check out Scott, and we'll be right back with more It's Only Money. Welcome back to It's Only Money. Hope you're enjoying your weekend out there. I'm here with Scott and Tammy from Edgewater Family Wealth. You heard the bumper. EdgewaterFamilyWealth.com is where you want to go to. But believe it or not, we are still in the numbers, baby, with Tammy.
That trip, man. Yes.
You interrupted him mid-number, and it got very frightening for a second.
Broke the number for a minute.
Yeah, he broke the numbers.
Yeah. So we were talking about major banks, and then we moved on to regional banks. And from there, since last week, we discussed the difference between a value company and growth company, etc. Some of the big value names, as we all know, because we use them every day, whether we like soda or not, and that is Coca-Cola, PepsiCo as well. Both of those had very positive earning.
Still making money.
Still making money.
Still selling Cokes.
Still making that, selling Coke in any flavor that you like.
But let me ask you this, though, because a value company would also count for like Anheuser-Busch, right?
Yeah, they're owned by InBev, but yeah, it's
when a company like that takes a hit and it's a value company, it's not, that's really kind of out of the norm, because I remember seeing like they had like a drop in sales of like 6% or their market share drops. That's kind of out of the normal.
That would be that's a pretty extreme market share loss for a company of that size. So yes, it's not impossible for a value company to get more valuable, right? The value to increase, otherwise known as the price dropping. So yeah, it's just a vague term. I don't love those terms. People get all bent out of shape if you say growth stock versus a value, and they have a camp. I like value stocks. I like growth stocks. I like dividends. I don't need dividends. This whole silly ideological Republican Democrat type thing that I don't quite understand. But people I think put too much stock in those types of names, but we have to call them something. So we do call big names that are around for a while and kind of stodgy and boring that pay lots of dividends.
These are loosey titles. It's never fit 100% because you might find one characteristic that fits it, but another that doesn't.
Yeah.
Just as you said.
Yeah.
So on that note, we also after we had the shutdowns in 2021 and etc., we started flying, right? You went to Germany, Ryan.
Yeah,
I remember. Yeah, do you remember which flight did you take?
American Airlines.
Okay, well, yeah, I was. Oh yeah, no, it's not here.
All right, pick another one.
All right, well, all the other ones years ago. They also started reporting earnings for this quarter, and not surprisingly, they are not making as much as they did the previous quarter. And that falls into the philosophy of, well, if you want to start cutting down on spending, you would cut down on the non-essential stuff. Travel, exactly.
Yep.
And that where it plays right there. Interesting. But as we said, it's not as bad as yet. And Tesla also reported the earnings. There was a lot of talk about that because their estimated earning was 1 cent higher than the actual one. Therefore, people freaked out.
Yeah, well, Tesla's, living a precarious life right now. As a guy, I don't know if you've heard of him, Elon Musk.
Who's that?
He's he's a little he had a bad couple of weeks, right? Because he had a rocket blow up.
Yeah.
He had to lower pricing on Teslas, and I think Twitter's still Twitter, so that's not good. So yeah, Elon's had a little tough run here, and that stock has been a bit precarious, and I don't suspect that'll change anytime soon.
Yeah, there's
do you count Tesla as like a tech stock or an auto stock?
No, it's a tech stock.
It's a tech stock.
Yeah,
it's a technology company that
happens to make cars.
Yes.
Right.
Okay.
Right. I think really I think if I had to guess that they really are hanging their hats on the battery technologies to kind of permeate the entire marketplace. If they could sell batteries to everybody for everything, they have the Tesla home battery for solar. They're trying to improve their battery capacity and the production of them, make it cheaper and easier and with less volatile materials that we don't have to dig up the tops of mountains in very bad places where they don't like us to get our materials. So I think that's the goal. I don't know if he'll get there. In the meantime, the Wizard of Oz, don't look behind the curtain thing he's been doing for a while was working. I think people are starting to peek a little bit behind the curtain.
Understood. And there's a lot of talk about their robo drive that is still under process, right? It hasn't fully been.
Yeah. I don't think people are ready for that yet. There's been enough very public mishaps with that people are like, I know personally, I'm not doing it. I'm not getting in a car that I don't have some control over right now. I suspect maybe in 5-10 years that'll be more prevalent. But right now, I don't think any of us are super comfortable with letting the robot drive the car.
Sure.
I saw a man sleeping on the way down 1792 recently in a Tesla, though. So that guy totally about that life.
Yeah, well, good for him. He's braver than I am, or sleepier than I am. I don't know which.
It was awesome. He was head back, mouth open, just.
That's crazy.
I'm glad he's going in the opposite direction.
So they're gonna have to put like drool pillows inside of Teslas now, so you don't drool on the because you could drool on the electronics and then everything goes haywire.
See, that's if the mattress company right now, I would get into making car seats.
Yeah,
this is a feather top driver's seat. Try it out.
I like it.
So speaking of that, I listened to the earning call for both Microsoft and Alphabet, Google. And can you guess how many times they mentioned the word AI?
Oh, well, every other word.
Like, dude, so many times, even compared it to previous quarter, like calls.
Yeah.
It's at least double.
The term AI.
Just saying, oh, we did this AI.
Yeah.
We're incorporating AI, etc.
Yeah.
Like they just keep hammering it home.
It's the new algorithm.
Exactly.
Yeah, it's they like companies would sell things and they'd be like, we got an algorithm that works. What's the algorithm? It's the algorithm.
So
every company's racing to like say they have AI in something, and a lot of them don't actually have it in there.
Right.
But that's the buzzword, and that's what gets people all excited right now.
Yeah.
Say it a lot. Repeat it often.
Yeah. Last year when they did the same call, they mentioned it like 6 times.
Yeah.
This year, 52 times.
52 times.
They're like, AI. Want to get coffee? But hey, you want to listen to what I have to say about AI?
Yeah.
What our listeners don't know is Tammy's half AI.
Yeah.
No.
Only half human.
Yeah.
My right half.
Yeah.
But tech stocks did well. Like Facebook didn't beat what everybody thought it was going to do because I saw a lot of people like kind of betting against Facebook in the way that you do in the stock market, and they came out like really good earnings.
Yeah, their advertising earnings are coming better because also they laid off a lot of people.
Yeah,
especially in the was it the thing, the virtual world thing that he's
Meta,
building?
Yeah.
Yes, he's trying to go easy on that because it costs a lot.
Yeah, he's trying to get ahead of that curve, which I appreciate about him. But when you're running a giant major corporation like that and you have shareholders, they don't like stories, they like earnings, right? So the quickest way to better earnings is to cut staff. Which is sad for those people, of course, but obviously this time around was pretty good for the stock.
It's funny to see where Twitter technically can become profitable with all the nonsense that Elon did.
Yeah.
Because with that checkmark thing, and then like the companies following behind it, like Instagram, and made a ton of money by having verified accounts and things like that. So it's like this stuff can turn around. And I remember seeing at one point, if Facebook charged for its services, it could just charge everybody like $1, $2, and then they wouldn't have to advertise to it all. And I was like, that's a better system. But they've chosen against that. Now they'll charge you for it and advertise you at the same time.
Well, there's that business models out there. I can't think of the name of the company that Scott Galloway helped incubate, but that company's out there where it's a recurring fee every month, and it's like $1 or $2, and there's no advertising and there's no sharing of data. Right.
Yeah.
So as they've often said, if you're not paying for something, you are the product. Right. Yeah. So this other option, if you alternative to Facebook, which obviously I can't even think of the name of it, or Meta, exists. It's just people haven't gravitated towards it yet. And I'm not going to sell Elon Musk short. The guy's accomplished amazing things, and he may fix Twitter. I often thought that he made the play to have kind of a super app where he could integrate Tesla, he could integrate SpaceX, he could integrate the Boring Company, and use Twitter as kind of that integration tool. And I suspect that's where he's probably going, but it's just going to take him a little bit of time. So really, we're just waiting for that integration to occur and the dust to settle on all the political noise that comes from being part of Twitter.
Mm.
And then are those the numbers, Tammy?
Well, we have one thing I wanted to mention is remember the risk-free rate we talked about?
Yeah, the Treasury.
The Treasury, yes. For the 1 month, we saw some peculiar movement happening there because usually,
Saw that.
yeah, you did that, right? You saw it.
I did.
And I want to mention something here because this mainly comes out of the money market because all the money market funds they base that on the 1 month Treasury,
right?
And usually it is steady; it doesn't move as much, but we saw a lot of movement, as we said.
Yeah, what he's referring to there, Ryan, is so we've entered an environment where a year ago you could barely get 1% on a money market or a savings account. Now we've entered into a rate war, where
like that.
It's the rate war, where banks and mutual fund companies are battling over your cash, right? And I know we have a product right now that has FDIC coverage that is paying 5%. I mean, that's the current yield, right? And there are many others like it out there competing, and a lot of the banks are struggling with that because obviously that's one of their, they make a lot of their profit by paying less than they lend at, and right now that's becoming more difficult as they fight in what I will now refer to as the rate war.
Oh, I like that. The impending rate war is well, I guess we talk about it when we come back. Good, bad for consumers, and we'll talk more. It's Only Money here on your listening device. Welcome back to It's Only Money, and we're hanging out here on the weekend with Edgewater Family Wealth with Scott, Brown, and Tammy. They're here to be your financial Sherpas through the mountains of retirement. That sounded good. I'm keeping that one.
I like that.
Wow, that was a good one.
And guide you through the impending rate war.
That's right. That's right. I feel like we should have like a wolf skin over our backs and some kind of weird moccasins.
Yeah,
I'm in.
And then you have the sound like in the background. Like,
do we get to wear hats with horns? Because that's my favorite thing. Or is that's Vikings? That's not sure.
It's either Vikings or Capital Stormers. Either way, you can do it.
I'd rather keep the market
Never
cap.
mind. I don't want horns anymore.
Market cap. Yeah. We have that on, and with this, I'll be great.
Yeah, we call it our market cap, and it has horn. There you go.
All right, now we're going
there's
somewhere.
the merch.
Yeah.
So the rate war is good. Is because I see all these things and it's like 4%, 5%. It sounded crazy to me earlier, but I have Apple products. I'm stuck in their ecosystem, and Apple comes out with a savings account that has 4.1%.
Yep.
And the qualifications weren't actually that high to get into it. And I'm like, oh, I should just take all my money and throw it in that, and then I can be rich.
Yeah.
And then when I'm rich, then I'm flashy watches.
Yeah.
I'm fancy cars.
Yep.
I'm fancy steakhouses. I don't even eat steak, Scott. I'm gonna go there anyways. And
You're just gonna order it and throw it on the floor.
Exactly, like a king. because once you get rich, you got to start acting rich.
You gotta be rich, baby. Yeah. The problem is it's not acting rich after you're rich. It's acting rich before you're rich that most people struggle with.
I see a lot of that.
yes. Well, if the surest way to not become wealthy is to act wealthy before you are in fact wealthy. Thomas Stanley, who was one of the co-authors of The Millionaire Next Door, which I think arguably is the best book ever written for a person on acquiring wealth. I always say to people, I bring this book up a lot because it's like 30 years old now, I think, but I read it when I was in my mid-20s, and it absolutely changed my life. And I suggest this book to people. If you can only read one book, if you can only have your children read one book about economics in this country and acquiring, and I'm not talking about becoming a billionaire or any silly stuff like that. I'm talking about being economically comfortable, having options in your life. The Millionaire Next Door is by far and away the best book to read. With that said, Thomas Stanley wrote a follow-up to that book called Stop Acting Rich, where they studied literally millions of millionaires. Now, this book was dated in 2009, so some of the data I'm going to give you is a little bit out of date, so to speak. But you'll get enough from it to understand the point. And one of the things that stood out to me as I was rereading it this morning in preparation for this conversation was that back in 2009, there were 1.1 millionaires who lived in homes that were valued at less than $300,000. So think about that for a second. You're a millionaire, and your net worth is more than your home. That's very few people can say that, right? Because there's a lot of people out there making 60, 70, 80 grand a year that live in $500,000 homes, right?
Yeah, mostly.
More people, about 73% live in that situation versus the 27% of millionaires there's only 27% of all millionaires live in homes valued at, this is 09, so those numbers may have changed a little bit, but live in homes valued at over $1 million, right? Now, if you're worth 50 million, obviously living in $1 million home is one thing. But if you're worth $1 million, $1.5 million, or $2 million, and people probably listening to this think, well, yeah, so what? Well, there's a lot of people in that category in this country who have gotten wealthy, not because they invented something, not because they were Elon Musk, not because they were on TV, not because they could hit a baseball. None of those things happened. They just slowly accumulated wealth by being smart. But again, 27% of all $1 million homes, so think about what I'm saying, were occupied by millionaires themselves. So what does that tell you? That tells you 73% of the people who live in $1 million homes, when you drive through these neighborhoods in Central Florida, the Aliquas, the Heathrows, the Windermeres, Isleworth, places like that, when you drive through there, you think, wow, these are really big houses. These must be very wealthy people. But the truth of the matter is about 70% of the people who live in those homes are not worth what the home is worth. Does that make sense?
Yeah. So their liquid cash might be, $70,000 and their stocks another 30,000. So without that home, they're not a millionaire.
Yeah, they're right. And even with the home, they're not a millionaire because they're leveraged to the gills, right? So they're typically high income people. So I think this is an important thing for people to listen to. And everybody's not going to fall into this category, but you can extrapolate it for your own purposes. Is it, typically it's a physician or an attorney who's, maybe they took the time and effort to go to law school or med school, especially in the case of a doctor who I use this example a lot, but they're 31, 32 years old when they finally start making some money. So they deserve to be paid. There's no doubt. I want my doctor well paid. Problem is they don't have any wealth. So they get the MD, they finally get with that, that practice. Now they're making $200,000, $300,000, $400,000 a year. Typically not four. Typically they start in the 2s and 3s. But then they go right out and they buy the big house, right? And I get it because there's pent up, consumerism there. They've been waiting while all their friends are buying homes and cars and stuff. They've been working,
studying and living on student housing and eating ramen noodles.
100%. Or living in that little cubby they have for residents in hospitals where they spend 100 hours a week, right? So I totally get why emotionally somebody does that. With that said, it's detrimental. So if you think about the lawyer, the doctor, some kind of high-end white-collar professional that starts making a lot of money but doesn't have a lot of wealth, and they buy a big fancy house. They go buy the big fancy house. Next thing they know, they're coming out of their house in the morning, getting in the old car that they've had for 7 years or 9 years or 20 years or whatever, and they look over and their neighbor's got a new car, right? Because you live in a fancy house, you got to have a fancy car.
Oh, yeah.
Right? So then they think, oh, okay, well, I live in this neighborhood. I probably shouldn't drive the 78 Pinto anymore. So I'm going to go buy a new Mercedes, right? So then they go buy the new Mercedes. All right, let's call it cooler jets. That's all cool. And then, the next night the wife says, or the husband says, hey, let's go to dinner at the club. What do you mean the club? Well, I mean, we live in fancy town, so we got to join the club. What do you mean join the club? Well, that's $50,000. Yeah. Well, you can finance it. Okay, well, let's finance it. So they finance the club membership, and then they go to dinner and spend $150 because you can't drink bad vodka. You got to drink whatever the most expensive vodka is.
Right. They don't got Skull at the club.
They do not. They do not. They don't have ABC brand vodka at the old club, right? So now you're ordering, $13, $15 drinks. By the end of the night, you're at $200-$300. So you can see where that one decision that professional made to buy the fancy house, that in and of itself may have not been the end of the world, right? Because you say, well, it's a house, it'll be worth something, and someday I can sell it, which I'll talk about in a second, because that's nonsense. But you think that, right? You can kind of convince yourself that, I'm going to buy this $2 million house, and I'm going to pay it off in 30 years, and then I'll sell it and buy a smaller house. We'll get into that in a second. But the reality is that decision to live in that more expensive, quote unquote, neighborhood brought on a whole nother slew of problems. The country club membership, the more expensive dinner, the more expensive car. Now your kid's got to go to the expensive school because Jimmy next door is going to the private school. You certainly can't have little Sally going to the podunk school down over here. You can't have that.
Picked up by a bus?
Yeah. What is that yellow thing that keeps showing up here?
Ridiculous.
I do
is that
not
a clown
care for
car?
It is unsightly. Get it out of here. So you can't. You can see where over time this would get in your way because all that you said. Well, I was going to buy a house and the house payment's $4,000, $5,000, whatever. I can handle that. Great. But then there's another $5,000 in nonsense. There's again country clubs and private schools and car payments. All these pressures that you feel as a person living in the fancy neighborhood that you succumb to. Meanwhile, if you had bought, say, a $400,000 house and invested the other $600,000 in some dumb mutual fund that nobody likes and still earns 8% a year for the next 30, you'd have a couple million at the end. The house would be paid for. You wouldn't have to pay for the fancy car. You wouldn't have, and you could continue to save instead of saying I'm a doctor and I make $400,000, or I'm a lawyer and I make $500,000 and I'm going to put 450 of it or 400 of it towards house, car, lifestyle. You're making a lifestyle choice. And I think that's where people get confused. They convince themselves, and I've heard this 1,000 times from physicians, is I'm buying the big house because it's an investment. No, you're not. You're buying the big house because you want a big house and because you want a fancy car and you want people to think you're cool, right? And I get that when you're young, especially, you those things are important to you, but you've made a lifestyle choice. You've made an investment decision, but it's a bad one, right? So again, it's tough to say I make $400,000 a year. I'm going to live in a $300,000 house because you're like, wait, I worked all these hours and I went through all this chemistry and did all these awful things that wore me out, and made me tired, and made me question my sanity. And now you want me to live in this house? But again, if you make that decision, it's not to say if you did that and then when you're 55 or 58 or 60 and now you've accumulated $3, $4, $5, $6, $7 million that you can't then double back and make that decision, right? Then it's okay because you have the capital to support it. But this is where I think people fool themselves continually, is to say, I am making an investment. No, you're not. You're making a lifestyle choice.
Wow. You just dropped truth bombs.
That's right.
that was hard for me when we were picking out houses, and I wanted to go big, and the money was available, and I was like, we should definitely do this. And I had somebody taper me back a little bit, and I'm so glad that we did, because I don't feel like I'm under constant stress having a higher mortgage payment than I would have to, really. And it turns out, little fun house to start out with, not so bad.
Well, and not only that, but if you have a little fun house and you get rolling, maybe that's something you could rent out to somebody else as time goes on and you accumulate more wealth.
If you want more amazing advice and truth bombs, Edgewater Family Wealth is where you want to go to. EdgewaterFamilyWealth.com is the website. There's Financial Talks with Tammy, links to past episodes. If you ever want to just stream this show while you're out and about, we are on all major podcasting networks, especially the iHeartRadio app. We'll be right back with more It's Only Money here on your radio. Welcome back to It's Only Money. We're here on the final segment of the show. Thanks for hanging out with us on the weekend. Tell your friends to go to EdgewaterFamilyWealth.com as well. That's where you get all the sweet, sweet financial advice. And we're going to talk about everybody's favorite thing, diversity.
Wait,
but when it comes to stocks and your options, more of a diversification, really. Because Scott was talking to me a little bit during the break. And he brought up something that I always thought was true. He's like, that's actually a falsehood, which keeps happening with me and Scott. And that was, I said, Scott, well, you want to diversify, of course, because you're hedging your bets in the market, right?
Kind of. It's not a total falsehood, but it's a little bit overstated, I think, or maybe misunderstood is the best way to put it. I think that where people, and we're seeing it now with crypto and some other things, we're seeing where people get so infatuated with an idea that's doing well now, right? That's called recency bias. Psychologists would say, we as human species, as human beings, we believe that whatever happened yesterday is likely to happen tomorrow, when in fact it's not.
Yeah.
Right.
Well, it sort of did for hundreds of thousands of years.
Yeah. Now things are changing very rapidly. Yeah. So I think that people get caught up in recency bias, and we all do it. It's a thing. But ultimately, what diversification does for you is it protects you against the unknown. And let's face it, most things are unknown. Like I've said it a million times, but you can't plan for the things that really bust the market. Bank failures. Nobody sat around 3 months ago and said, what if the giant Silicon Valley bank has a problem? Nobody said that. That just happened. Right now we're reacting to it. Nobody sat around in 2001 and said, what if some people terrorists fly planes into buildings? Nobody said that, but it happened, right? It was a big market moving experience. Nobody sat around in 2005 and said, what if this whole housing excitement is just a bunch of nonsense? Nobody had that conversation until it happened. So if you recognize that a lot of these things that happen, especially in a capitalistic society, a market-driven society, a quote-unquote free market society, which obviously we don't completely have, but that's another story. If you participate in these things, you have to know a lot of the things that are going to happen to you couldn't have seen coming. So how do you protect yourself against that concept? Well, what you do is you diversify. I'll use the 06, 07 housing market as an example. If you said, hey, I bought a house, oh my gosh, I didn't have a lot of money, but I scrapped together about 10 grand and put a down payment on a house and I paid 100 grand for it. Now it's worth 200. However you came to that conclusion, right? So now you say, well, I got 100 grand. I'm worth $100,000 more dollars. So I'm going to take that and I'm going to take the equity out of it. I'm going to go to the bank and say, hey, I got 100 grand in equity. Can you give me 80 grand on that? They say, sure. Because of course the market's going to grow to the sky, the housing market. And so they gave you the 80 grand and then you went back and you bought another house, right? Because you knew from recency bias, because of what just happened, that clearly that was a can't lose proposition until 2008 when it was a total lose proposition. Yes. What if you did the same thing? You took the 80 grand out, but you said, you know what? Maybe I ought to cool my jets on housing. I'm exposed there. Maybe I ought to take 40 grand and put it in cash. Maybe I ought to take another 40 grand and put it in the bond market or the stock market. Now, stock market wouldn't have helped you at that moment, but let's say it was the bond market, right? You diversified into cash, you diversified into the bond market, and you still had your real estate. Then 08 hits, the whole real estate market falls apart, and you don't have to panic, right? Unlike the first person who turned around and took their 80 grand and put it back into real estate, they are all in on real estate. So when real estate has a bad day, and listen to me, all of you out there, all 5 of you, listen to me. Real estate will have another bad day. Stocks will have another bad day. Bonds will have another bad day. And if you're all in on any of these ideas, you're ultimately going to panic because you have no choice. You're all in on the idea. But if you had 40 grand in cash and you said, all right, well, I probably shouldn't have borrowed that money out of the house. I probably shouldn't have taken that equity line. But the good news is, honey, to your husband or to your wife, we've got this cash. We'll wade through it. We'll wait for the market to recover or at least slow down in terms of depreciating. And we're going to be okay because we diversified. If you don't give yourself options, if you paint yourself into one corner with no little escape hatch, more often than not, that's going to end catastrophically. It's the rare person that buys one thing, one stock, one bond, one piece of real estate, or one type of investment and becomes successful, because eventually that thing is going to struggle. And when it does, they're going to get blasted. And when they get blasted, they're going to panic. And when they panic, they're going to get out and they're not going to recover. I mean, think about the professionals, right? Private equity companies. We hear so much about private equity and venture capital. Those guys will buy 100 deals a year. And they're all different. They might buy a plumbing company. They might buy an investment company. They might buy an electrician. They might buy a grocery store. They might buy some kind of new widget. They might buy a tech stock. They're not buying all of one thing because they know of the 100 deals they're going to do, 20 of them are going to be total home runs. 20 of them are going to carry the other 80 because 40 of them are going to go out of business. Another 20 or 30 are going to do just okay. That's that 20 that they diversified into that carried the whole thing, because those are 10x deals where they made 10 times their money. So my point is, if you treat your investment capital as a homeowner or as an investor, as a retail investor, like a venture capital company where you diversify, you know some things are going to do poorly at certain times, but you're not going to panic because you have the other things that will support you through that down period. And that's why we talk about cash a lot. And right now we're talking about what great rates you can get on cash in various places. People get all wigged out if you say have a big cash position. Oh, I'm not making any money. Sometimes we win by not losing. And if you have cash and your favorite market, whether you're a real estate person or a stock person or a bond person or a whatever, person, that cash that's available will allow you to take advantage of opportunities that occur in whatever your favorite thing is when it drops, rather than having to panic because you got all your money in said favorite thing.
How much do you recommend somebody has in cash as like a war chest at any time? What's the ideal number
Well, and this is a
or
tough
percentage, really?
Yeah, I mean, I think it's a tough one. You'll hear all kinds of things from 3 months to 6 months to a year. I think it depends on the person, and I think it depends on the volatility of their situation. So I don't think you should ever invest money, ever, not a dime in a mutual fund, not a dime in anything, until you have at least 3 to 6 months cash on hand. Because the problem is, if you say you get overzealous and you heard Scott on the radio, now you can't wait to invest because I have that effect on people. And you say, "Oh, I saved up $1,000. I'm going to put it all in the market," and then the transmission goes out, or the air conditioner at the house, or you have a roof problem, or a medical issue, or whatever. Now you're selling the thing, whether it's up, down, or indifferent, right? You're forced to sell at possibly an inopportune time. So what I love about cash is it keeps you out of the 401k. It keeps you out of the IRA. It keeps you out of the Roth. It keeps you out of the long-term savings. It allows you the cushion to allow the other investments to do what they need to do over time. Because if the market drops and all of your money is in the market, that's going to be uncomfortable. But if the market drops and your 401k goes from 10 grand to 9 grand and you got 15 grand in the savings, you get like, whatever. I mean, I got time. I got cash. I'm not living on this money, right? But if you are in a situation where all 15 grand is in the market, that's a different conversation, and it's likely to lead to an emotional bad outcome.
Interesting. So, other than just your money's not making interest or whatever, or it's your money's not working for you. You hear that a lot. That's the biggest one. But is there truly a downside to just having a pool of cash available?
I don't think so. Again, I think if it's cash, it's not working capital. It's just money that's there to protect you when something goes wrong. And let's face it, this is life. Things go wrong. I don't know anybody that can come through this thing. Nobody gets out alive, as they said. So I think that the reality is cash may not be a great investment, quote unquote, but in my mind, it is a great investment. It's an investment in your peace of mind. It's an investment to know that you can let other things that are long-term oriented and go through ups and down cycles. It allows them to do that. But if all your money's in long-term things like stocks and bonds and real estate, and one of those things struggles and you have nothing to fall back on, you're forced to sell at a time you probably don't want to sell, which is the undermining of every investor's bad experience.
And when you're diversified and say you got your cash, you got your real estate, you got your stocks, you got your, I mean, are we looking at a pie chart that's sort of equal on all ends, or or is the more natural way to okay, it's going to be, the biggest chunk is going to be stocks and real estate? I mean, is there an ideal way?
No, there really isn't. I mean, it depends on so if you're a real estate person, let's say you're a real estate broker and you know real estate, right? And you're like, I'm comfortable in this world. Maybe you have a disproportionate amount of your capital in real estate because you're comfortable with it. That by no means, I know lots of real estate brokers are very successful, who are clients of mine, who have a portion of their money in IRAs and 401ks and mutual funds and stocks and bonds. It's not maybe it's 30% and they got 40% in real estate and the rest in cash or whatever, right? Maybe it's not the higher percentage. Conversely, if you're a stock and bond person, you're in my business. I'm comfortable in this world. I might have more money in stocks and bonds because I'm comfortable with it. But I still own my building. I still own real estate. I have a rental property. So again, these people just get caught up in these absolutes, and it's very detrimental.
There are no absolutes. And that's why when you're working with your money, you want to work with people that don't deal in absolutes, that just they look at you and your situation and decide what's best and most comfortable for you. That's why I call them financial Sherpas, because they're there to get you where you want to go. And kind of lead you on the path, but not carry you the whole way. It's all about you. That's why Scott does those meetings with his clients and talks about, hey, how do I work for you? And that's where you want to go to edgewaterfamilywealth.com to get a hold of these gentlemen. Scott, Tammy,
have a great one.
Happy weekend.
All right. See you next time on It's Only Money.
Yeah, and clearly people are rich, right? Or wealthy. You don't have to be rich. I like the term wealthy better. I mean, to rich reminds me of like the Monopoly guy or something. But, you know, they're regular people.
Now that guy I trust. You
Yeah,
see the problem, Scott? You don't have a monocle.
Monocle is, now, if you can meet a guy with a monocle, I mean, like, I'm all in.
What was his financial advice? He said buy Park Place?
Where is that?
Where is that? I can't find it.
Tune in to It's Only Money with Scott Brown from Edgewater Family Wealth, Sunday mornings at 7 on Real Radio 104.1. Raymond James Financial Services, Inc., member FINRA SIPC. Edgewater Family Wealth is not a broker-dealer, is independent of RJFS.